Let's start having a look at some of the common methods of analyzing and relating the data in financial results, in fact, financial statements. And as we do that, we start to gain a much more clear picture of the solvency and profitability of a company. Solvency and profitability are the two words here that really make a difference, I think. And they're the two words that we're really looking at all through our analysis of the organizations that we're actually looking at. So, what is the profitability and how solvent is the organization? Solvency means how quickly can it pay its debts and all that type of thing as well. How do we do it? Well, we do it through financial statements. And that enables us to get it. But investors look at financial statements, creditors look at financial statements, and regulatory agencies look at financial statements. Although everybody's got different goals, their overall objective in financial statement analysis is the same: to make predictions about an organization as an aid to decision making. That's quite powerful in its own right. Remember this for your assignment. Although these users have different immediate goals, right? My goal as a manager is different to your goal as an investor, but we're all going to use the same statement. We're all going to use the P&L. We're all going to look at the balance sheet. We're all going to look at the cash flow statement to make the decision that we want to make about the organization that we're working with, or about the organization that we're looking into, which brings us obviously to the objectives. Similar. Management analysis of financial statement primarily relates to parts of the company. Using this approach, management can plan, management can evaluate, and they can control operations within a company. And what we're seeing within a company is lots of departmental P&Ls or income statements, whatever you want to call them, lots of departmental P&Ls that come together to one ultimate P&L for the business as a whole and all the rest of it. But we break it down. The organization breaks it down into workable chunks, if you like, to go through. And obviously, management is going to have. So there are certain things we need to do legally, which we've already talked about. We need to have a P&L. We need to have a balance sheet. We need to look at cash flow. We need to be ready to report. But the management of the company can ask for anything it wants, basically. So the idea behind solid accounting is that when a manager asks for a particular report, then he or she can get hold of that report within 24 hours or whatever it might be. And, a powerful, or most basic, actually, financial management systems, you'll be able to pull these types of reports automatically in the system. So you don't always, for management reporting, you don't always need an accountant behind it to get you the numbers. Quite often these days, with the systems that organizations are using, reports can come straight away. I was even doing some personal banking yesterday, and there was even lots of reports there that I could find online about my accounts and my financial situation and my debts compared with the assets and all that type of thing. And so similarly, with a large system with an organization, management reporting is going to be getting better and better and stronger, especially with all these ERP systems and all this type of thing, enterprise-wide IT support systems that organizations have. Then we all each have a window according to our role into that system, and can look at the eyes of the organization and start to make the measurements that we need to make. Look at the report that we want to look at and all that type of thing as well. But why do we want this? Well, quite often we need this information for all sorts of purposes, of course, but it's often when we need to make difficult decisions. For example, when do we expend operations? How do we expend operations? In other circumstances, which are the employees that we should be laying off? So it really is about the reality of the organization. It's a window into the organization. We're going to talk a little bit about not necessarily the reports accountants prepare for management, but we'll talk a little bit about the information needs of people outside the firm. So, think about the stakeholders outside a firm. Well, they include investors, right? They include creditors. They include regulatory agencies. they focus the analysis of their financial statements generally on the company as a whole. They can't request special purpose reports that a manager can. So they tend to have to rely on general purpose financial statements that companies publish. You know, it's unlikely that, you know, a regulatory agency asks for very tailored reports of confidential information. It's highly unlikely that an organization is going to give it to them because it's going to cost money to put together and all the rest of it. So these statements, the ones that we've put together, as we've talked about, they include a balance sheet, an income statement, a statement of stockholders' equity. Okay, that's fair enough. Who owns the business? And a statement of cash flows with explanatory notes that accompany the financial statements. All of this you'll find in a company's annual report. So it's generally information that is available. And of course, publicly listed companies are the ones that produce annual reports that are publicly available. Private companies, then they don't usually publish them, but they're obviously available to their various stakeholders as well, and their directors, their board, and their investors and all that type of thing as well. But that financial assistant statement analysis, so we have the financial statements. The financial statement analysis consists of applying analytical tools and techniques to these financial statements and other relevant data to obtain the useful information, or to obtain the information that we need. Okay. Okay, let's have a look here for a second at comparative financial statements. So I think I mentioned, you know, we want to be in a situation where, you know, there's no sense in just looking at a bunch of numbers if we don't have anything to compare them with, right? And how do we know if we make $100,000 profit, if that's good profit for our industry or good profit for us compared with other periods? So we can enter into financial comparatives or financial comparative financial analysis, where we start looking at our organization at different points of time. So when you look at a lot of P&Ls, for example, it'll say, you'll have the various columns. So you have everything with P&L. It's basically revenue minus cost of goods sold, to which is your profit, minus all your other expenses, to which is your net profit. Okay. And they all follow the same format. So quite often when you're working with an organization, it'll have last year's numbers sitting next to this year's numbers. And also, and just in the column down below, it's like 2020, 21. On the column on the left, it might have 2022. As a manager, you might actually say, okay, let's compare this with other organizations and start to look at your ratios compared with their other organizations in the same field. But highly likely, when we're looking at financial statements, highly likely to present the same company's financial statements for one or two successive periods in side-by-side columns. You know, also, we've got to account for things like dollar changes or percentage changes in the statement, and what we will call as a horizontal analysis. But basically, this type of analysis, comparing apples for apples, enables us to detect changes in our performance and highlights change. You know, I used to work for an American company, I think I've explained to some of you before, and I was responsible for 16 different countries across Asia Pacific. And when we were comparing a P&L, we'd have a P&L for the whole region. We'd have a P&L for each country. And in fact, we have a P&L for each division in each country. So you can see how it all starts to add up. But of course, the comparison's not easy in the first place because not everybody's dealing in the dollar. So what we would do for that in those cases is, once we've got the local P&Ls, we would convert them to US dollars. In fact, I was working for an American company, so they were chasing after US dollars anyway, and they have to report in that. But also for our comparisons, and if we were looking at comparing ratios between those different countries, and sometimes it might not be about performance of the organization because it's a very different political or economic or social circumstance. So the ratios are not necessarily the same for each country, but putting them in the same currency enabled us to make those types of comparisons. So, and also we look at what was it last year? You see again, again, this is part of this horizontal analysis. Is like, well, we made $100 million this year, but actually we made $120 million last year on less revenue. $120 profit on less revenue. How do we work out what went wrong? How do we start to analyze that? And it's called horizontal analysis because we look at one account at a time across time. One account at a time across time. So we're just going through and saying, okay, we'll look at it on the P&L or the balance sheet and saying, well, this is what it looked like this year. This is what it looked like last year. And that side of things, and over that as well. Yeah, Harper, no worries. See you next week. Thank you, Harper. Enjoy the rest of your weekend. Excuse me. I just need to get the chat off my screen. So hopefully that makes sense. And really not to overcomplicate it. Horizontal analysis is just looking at comparison of different units over time.